Team, we are currently living during a historical moment for the ages. The tariff chess match is wild and unfolding right before our eyes. And while it's painful and frustrating to watch it at the street level, it is incredibly interesting. And it's anyone's guess to how this all plays out. This is a wild card that wasn't on our list, but let's talk about it. First, yes, this has been incredibly painful from a lender and a realtor perspective because rates have increased and the stock market has been all over the board. The tariff chess match is fully underway and the ramifications are being felt across the world, not just America. I mean, we saw some of the best inflation data that we've seen in years last week, and the market didn't even bat an eye. It was like our 3-year inflation problem wasn't even real last week. It's wild. As a result, Goldman suggests that last week's flat to lower inflation data from March appears to be backward looking and maybe not relevant. You think so? As a trade war plays out, stating today's softer than expected CPI release feels backward looking given the large changes to trade policy seen in recent days. Going forward, the Fed is likely to face a difficult trade-off as tariff-driven prices increases start to feed through the inflation data and activity remains soft. We expect the Fed's initial reaction to be cautious, but the risk remains that a sharper than expected slowdown in the economy could result in a resumption of the Fed's easing cycle. Now, translation, and not to fast forward to the end of the chess match, but this is a likely outcome. The market slows down. Many say that we're already in a recession, and this puts pressure on the Fed to cut rates sooner rather than later. But how do we explain all of this in a way to our consumers that they will understand? Let's give it a shot and break this down in the simplest of terms. Tariffs are essentially taxes placed on imported goods. They raise revenue for the government, but they also increase costs for both the foreign producers and the domestic consumers, that's us. That means higher prices for everyday goods, including key items used in housing and construction like steel, aluminum, and appliances. So how does this affect real estate? Higher tariffs on building materials may lead to higher construction costs. That slows down new home development, tightens inventory, and could drive up home prices. Now, let's zoom out. Tariffs disrupt global efficiency. They reduce trade flows, they raise prices, and if other countries retaliate with the tariff of their own, it spreads inflation and economic stagnation worldwide. And that's called stagflation, which is simply slower growth due to higher prices and high unemployment. A tough environment for everyone. So what do? Do you lower rates to spur on the slowing economy? Or do you raise them to combat inflation? See that dichotomy? So why does this matter to you? In the big picture, the US is trying to reduce the dependency on foreign goods and capital, especially in a time of geopolitical uncertainty. That shift may bring unconventional changes to how we build homes, fund mortgages, and manage debt. If global trust in the US debt or the dollar weakens, that could reshape the entire financing landscape. See, tariffs are not just about trade. They're about inflation, interest rates, housing supply, and long-term economic shifts. The more you understand these forces, the better you are positioned to guide your clients and adapt your strategy and stay way ahead of the curve. Big shifts create big openings, and those who stay informed will be the ones who win. Make sure you're one of them. Stay sharp, stay curious, and we'll navigate all this together. See you next week.